PPIF, you woke up this morning and checked the price of silver and saw it sitting at $47, and for a brief moment felt relief. Felt like your strategy finally paid off. After years of being mocked for stacking physical metal, I need you to stop and really think about what's happening. That feeling of victory is an illusion, a temporary mirage, because the landscape you're operating in is shifting beneath your feet. While you were celebrating a number on a screen, the rules of the game were quietly being rewritten, and the new rules are designed to strip away the gains you thought you earned. This is not speculation or fear-mongering. This is the reality of systemic financial engineering. You didn't win simply because the price went up. The victory you imagined is conditional, fragile, and potentially fleeting. The IRS and Treasury have been quietly crafting a framework that would classify gains in precious metals as windfall profits, subject to extraordinary taxation. Think about what that means. All those years you were patient, all those months of watching the paper market manipulate spot prices, all those sacrifices in favor of holding something tangible, could now be punished by policy. Imagine buying silver at $19 per ounce and holding it through a multi-year cycle, only to find that the government claims the right to take most of your profit in the name of speculative fairness. The numbers are shocking. If you made a $28 gain per ounce, under a proposed framework, you could be left with just a fraction of that, turning a strategic decision into a near-zero net outcome. That is the operational reality you need to comprehend. What makes this situation especially dangerous is how the mechanics are designed. The government does not need to confiscate your metal physically. They've learned from history that outright seizures, like those in 1933 under Roosevelt's executive order, generate public backlash in underground markets. Today, it's all about taxing gains to the point where owning metal becomes economically irrational. If this proposal passes, a rational investor would ask, why hold silver if 80% of the upside evaporates? The logic is brutal but elegant from a policy perspective. By making the asset unprofitable, they extract the supply indirectly without inciting resistance. And timing matters. If silver has recently rallied, you can be certain that policy is being drafted to coincide with market moves. These aren't accidents. The movements in spot and paper markets are closely watched by institutions that have enormous leverage over both price and narrative. When silver breaks through key resistance levels during thin liquidity periods, it triggers alarms within regulatory bodies and financial institutions alike. Soon after, proposals emerge, talking points are distributed to the media, and the narrative is spun. This isn't a punitive measure, it's a protective measure to curb speculative excess. The irony is sharp because these policies often hit smallholders far more than large institutions, who can exploit loopholes in alternative channels. You also need to understand the structural fragility of the COMEX system. Registered inventory is minuscule relative to the open interest in paper contracts. This means that even a modest surge in demand for physical metal could overwhelm the system. Yet the narrative keeps the public calm. Prices are stable, liquidity is sufficient, risk is contained. On the other hand, international markets tell a different story. Chinese demand, premium spreads between Shanghai and COMEX, and record imports indicate that physical supply is tight. The disconnect between paper and physical pricing is the kind of signal that can precede extreme market events, but most retail investors don't notice it until it's too late. The proposed taxation framework also serves a strategic function for the institutions that dominate commodities trading. Banks with massive short positions cannot cover without enormous losses if prices surge beyond their risk thresholds. If silver spikes to $60 or beyond, they face the choice of absorbing catastrophic losses or leaning on policy intervention to suppress the market. The windfall tax effectively becomes a firewall to protect these institutions at the expense of smaller holders. It is socialized risk and privatized profit. Understanding this isn't paranoia, it is acknowledging the way modern financial systems distribute risk and reward. The mechanics of taxation are also cunning. While headlines might scream 80% windfall tax, the implementation could be structured to create the impression of fairness while still extracting a significant portion of gains. Splitting gains into inflation compensation and speculative profit allows policymakers to craft numbers that sound reasonable but achieve the desired effect. Confiscatory in practice, palatable in presentation. By anchoring the narrative on fairness and stability, they prepare the public to accept the policy before anyone fully comprehends the implications. If you own silver now, you need to be deliberate. Understand your cost basis. If you bought at lower levels, the tax may not immediately devastate your position, but the psychological effect on the market will be profound. Dealers will be caught between thin margins and a sudden collapse in retail demand. Premiums could spike or drop sharply depending on panic behavior. This is why monitoring physical markets in real time is crucial. The real intelligence comes from talking to dealers, tracking spreads, and observing inventory levels firsthand. Mining equities are also highly sensitive to this framework. The underlying price of the metal directly impacts profitability and valuation. Investment slows, production stagnates. In a few years, supply-demand dynamics could tighten so sharply that the next cycle triggers a dramatic spike in physical prices, leaving retail investors without access. This is not theory. It is the predictable outcome of combining regulation, market psychology, and capital incentives. Globally, this policy sets precedent. If the United States imposes a punitive windfall tax on precious metals, other developed nations are likely to follow. G7 countries in particular tend to coordinate regulatory measures to maintain financial stability in their shared context. Meanwhile, emerging economies that are actively accumulating metal, China, India, Russia, and Brazil, will create a bifurcated market. The West suppresses demand through taxation. The East accumulates physical reserves. Price discovery shifts, liquidity concentrates elsewhere, and the role of the dollar in commodity settlement may erode incrementally. This is long-term strategy being executed under the guise of short-term fiscal policy. The mechanics extend into derivatives and options. Meanwhile, those with a sophisticated understanding of leverage and hedging strategies can anticipate cascading effects that retail investors will only see in hindsight. Even industrial demand plays a role in this equation. Silver is essential for electronics, solar panels, and EV production. Policymakers understand that limiting speculative buying through taxation frees up metal for industrial uses without increasing supply. Essentially, you are being taxed out of a market so that industry can maintain access at controlled prices. This is not a conspiracy theory. It is public policy applied strategically to a scarce resource. The effect is subtle, systemic, and deeply consequential. Bitcoin and other digital assets introduce an interesting dynamic. Unlike silver, crypto does not have industrial use. Any attempt to tax windfall gains aggressively in the crypto market would be met with litigation, regulatory challenge, and infrastructure resistance. This asymmetry could incentivize capital flows out of taxed assets and into crypto, creating arbitrage opportunities for those able to act quickly. It is an unintended consequence of selective taxation. Physical metals are constrained, digital assets are mobile. This is the tension that will shape financial flows in the coming years. The precedent this sets is significant. Once the concept of confiscatory taxation for speculative gains is normalized, the policy can be expanded to other asset classes. The underlying principle is incrementalism. Start small, normalize the action, then expand scope. This is why understanding the current windfall tax proposal is not just about silver. It is about recognizing the direction of policy for all wealth preservation strategies. Your response must be calculated. Selling in panic is exactly what the system anticipates. Wading through volatility requires discipline and awareness. Monitoring legislation, dealer behavior, international spreads, and media narrative is critical. If the tax passes as expected, the initial sell-off may create short-term chaos, but those who understand the mechanics can navigate it effectively. Buying aggressively during uncertainty is equally dangerous. You could become subject to retroactive taxation without the ability to exit economically. Timing, information, and comprehension are everything. Communicating with other holders and building a network of intelligence is more important than ever. Retail participation matters less in terms of market mechanics and more in terms of shared situational awareness. Crowdsourced information on local inventory, premiums, and dealer behavior can provide insight that official channels obscure. Real-time, granular intelligence allows you to anticipate liquidity stress, arbitrage opportunities, and potential policy enforcement actions before they hit the mainstream. This is why engagement matters, not just for digital reach, but for survival strategy. Every conversation, every post, every piece of field intelligence contributes to understanding the dynamics of this market in real time. Mainstream media will present a sanitized version. The reality will be different. Recognizing divergence between public reporting and operational reality is the difference between reacting to noise and acting on signal. The underlying math also cannot be ignored. Understand your gains relative to inflation, cost basis, and speculative classification. What looks like a confiscatory rate may in practice be applied in ways that feel both shocking and procedural, leaving many investors with significantly reduced returns despite compliance. The numbers matter. Ignorance is costly. Finally, the broader geopolitical and macroeconomic context is unavoidable. Capital flows, foreign reserve management, and strategic industrial requirements all intersect with domestic tax policy. Policy is not just about raising revenue. It is about controlling capital allocation, protecting systemic financial institutions, and preserving strategic advantage. Understanding this context helps you anticipate the long-term effects, including potential arbitrage, international storage solutions, and hedging strategies. In conclusion, the situation is complex, dynamic, and high stakes. Emotional reactions will cost you more than deliberate, informed actions. This is not just about silver prices or even about the metal itself. It's about the interplay of regulation, market psychology, leverage, and policy. Recognizing the patterns, preparing for contingencies, and acting with precision is the difference between preserving wealth and watching it erode under new policy frameworks. Awareness, strategy, and situational intelligence are your most valuable tools. The rules are changing. You need to understand them before they are enforced, or the cost of ignorance will be measured in dollars lost. Opportunity missed and leverage surrendered to those who already control the system. The window to act is narrow. Observation, networking, and careful analysis will determine who navigates the coming months successfully. This is the reality of operating in a terminal phase of fiat manipulation, a complex, multi-layered system where the interplay of policy, liquidity, and human psychology dictates outcomes more than price charts ever will. To survive and thrive, you need to think beyond the screen, beyond the news, and beyond conventional wisdom. Your strategy must account for regulation, leverage, and timing in ways most investors will never consider. Prepare, observe, and act intelligently.